welcome to the Everguide Financial early 2021 webinar. I've got a lot to go over today, so I'm just going to get started and we'll jump right into it. So let's start off by seeing where we are now. And basically, we're 10 months into a global pandemic with vaccine rollouts starting, actually an end to the health crisis in the near future. We also have record asset prices, speculation is rampant, Federal Reserve and the government continue to provide stimulus, and there's political unrest, and it's not just here in the United States. So one of the things that is interesting, because markets are usually forward-looking, is there's really no bad news coming up. Vaccines are going to reopen the economy, and it's going to surge with pent-up demand. The Fed has stated they're not going to even, in fact, yesterday Powell even said, we're not even thinking about tightening monetary policy. With the Democrats pretty much in control of everything starting next week, they're going to continue to provide more and more stimulus for the economy. Also, the bear market ended in March, so 5 weeks in duration, and we are now, after March, we started a brand new bull market. So bull markets last a long time. It's very, very young. There's nothing to look that could go wrong. And then lastly, we're in a new paradigm with technological developments, with Bitcoin, electronic vehicles, the cloud, artificial intelligence, gene therapy. So there's a lot of different industries where there's a new paradigm. So this is a quote, and it's going to be important throughout this entire webinar, and it's something to think back on. And this comes from Bob Farrell from Merrill Lynch. He's a pretty prominent, used to be a pretty prominent person on Wall Street. And it's parabolic advances usually carry further than you think, but they do not correct by going sideways. And so based on what's happened over the last 9 months, there's quite a bit of parabolic moves. And it's interesting to think. Parabolic moves up don't end by going sideways. So usually we talk a lot about the economy. Today we're going to spend just a little bit of time. And part of the reason we talk about the economy is because, as you can see by this chart here, it's a little hard to read, but the green just shows correlation. So up here would be 1-to-1, meaning the economy does great, the stock market does great. And this goes all the way back to the 1960s. Usually when the economy does well, the market does well. When the economy doesn't do well, the market doesn't do well. What's interesting is you had a little bit of a blip here in the mid-1990s, and then we go to the peak of the economy was really in 2018, and stock market continued to move, and to the point where you had the only time ever we've had an actual negative correlation, where the worse the economy got, the better the stock market got. So it's just interesting. One of the things looking forward is, well, okay, yeah, that was a one-off, but as the economy gets better into 2021, then this relationship's going to jump back up. We're going to have high correlation. The market's going to continue to move higher. So we'll see. One of the things, I'm just going to talk briefly about recessions, because we're still in the middle of and coming out of a recession for 2020. Recessions are a healthy part of the business cycle. And the reason they're healthy because it cleanses the previous cycle's excess and then promotes innovation and productivity. And so one of the things I want to look at here, and part of the excess is debt. When people feel comfortable and they want to take a lot of risk, they use a lot of debt. And so one of the things that's important when you're looking at this is recessions, they get rid of that debt. They purge it and they go back and they get productivity. Here you can see, so the gray bars are recessions going back, and this is through going back through 1980. They are the recessions. And what you can see is there is 1990, there was a large amount of debt taken. There's a large amount, a small amount in 2000, a huge amount in 2008. And, there's other periods where debt goes up and debt comes down. In fact, here, there was actually a larger drawdown in debt in 1998 during the Asian financial crisis. Now, this is interesting because we will go back to this time period a few times throughout this webinar. And you can see even here, this is a drawdown. This was the in 2011. This was the European financial crisis, and you can see a brief drawdown here in 2016. That's when oil prices collapsed. But what's interesting is almost in every single recession, it has caused people to reduce their debt, and sometimes it goes up. Now, what's amazing is if you look at the last couple of years, is there has been an explosion to the upside in debt. And even when we got into the recession, we're still well above levels we even saw in regular times previously. I'm not going to get into details, but that really stands out, and that is not good for the long term. So the last part about the economy is, and part of the story last year was, well, the market is not the economy. The market is not the economy. There's been this gigantic disconnect. So one of the things that's interesting here, this is nominal GDP. What makes it up? 30% is the government, and that's obviously growing with how much money we're just pumping in through the government. But the fascinating part is when you come down here, technology makes up 6% of GDP. 6% of GDP. And then here is employment. So, and again, this is just for laughs. 30% or 29% of GDP is made up from the government, but 36% is they use employment. So again, more employees, less GDP. Not very efficient. But again, we'll go back to technology. Technology is 6%. It actually only makes up 2% of employment. But when you go to the market, technology makes up 38%. 38% of the market. There's a gigantic disconnect between the economy and the market. And it makes sense. Last year, there was a lot of people that were forced to use technology, and technology stocks did well. There was a good reason for it. So that was our talk about the economy. Now we're going to go into company fundamentals, because at the end of the day, again, company fundamentals do not necessarily reflect the economy, even though there's usually a high correlation. We talked about technology and the difference between the economy and technology for last year. But if you look at everything as a whole, corporate fundamentals, actual profits is what drives prices over the long term. Now, prices can move away from fundamentals during periods of time, but over the long term, it's corporate profits. So this looks at corporate profits relative to the S&P 500 going all the way back to 1970. So as you can see, they track very, very closely going up to the mid-90s. And then here, so the blue line is the S&P 500, the orange line is corporate profits. So there was a big disconnect in the bubble of 2000. And you can see corporate profits were pretty stagnant through the late part of the 1990s, yet stock prices continued to move higher. And again, the reason why I point this out is what's interesting is here you have this gigantic downturn, 2000, 2003, bear market. Now, in that we had a tiny, tiny recession. Barely anything happened. I mean, it was very, very, very small, and that was brought on by the attacks of 9/11. Now, what's interesting is corporate profits actually started to rise, yet you still had a 50% drop in stocks. So the prices got so stretched that even though fundamentals improved, prices still came down until they matched up. And again, they matched up again and mirrored themselves pretty much through the Great Recession. What's interesting is then coming out of it, corporate profits actually improved much faster than prices. And again, it's interesting because stock prices are supposed to be forward-looking indicators, meaning they move before prices, or prices move before profits. Okay, so then eventually they catch up and they get somewhere here. And now prices have continued to draw a gap. Now this gap compared to this gap is it dwarfs it by every stretch of the imagination. And also corporate profits have gone nowhere really since 2012, even though prices have continued to go up. Now here you've got this downturn. Again, magnitude of downturn in corporate profits is equivalent to what we saw in 2008. Really no difference. And we never saw a drawdown going back of corporate profits that dropped the way they have in the last two crises. The only difference is prices dropped 60% in 2008, and they dropped briefly in 2020 and then went back up. Now the question is, okay, well, it was a pandemic, we have a vaccine, corporate profits are going to come back, technology companies still did okay, and this factors in technology companies. So let's just say even if they bounce back and go higher than where they were at the peak, we still have a gap between price and fundamentals that's larger than it ever was back in 2000. So it's just something, again, to keep an eye on with what's happened in this market and how disconnected we got. So now we're going to talk a little bit about valuations. And valuations, I'm going to admit, they are a terrible timing tool. They are a terrible timing tool. But they do make as a great long-term indicator because valuations matter. Again, I will go back to this. Stock prices dropped 50% while profits were going up because of valuations. They were just way too overvalued. So a lot of times people will point out a valuation metric. It's price to earnings or it's price to book. There will be something that looks stretched. But you really need to look at everything as a whole. What's fascinating about this is this S&P 500 valuations, whether it's total market cap to GDP, enterprise value to free cash flow, price to sales, price to book. No matter what metric you look at, where we currently sit, 100th percentile, meaning the most expensive all time. It's most expensive all time. It's most expensive all time on every metric, except for a couple here at the bottom. Even those are near all-time historic highs. Doesn't mean that they can't get more expensive, but again, it just adds risk to what's happened. So again, we're going to take a look at valuations here because short term, again, valuations don't matter in the short term, but eventually they do. Valuations always matter. And I don't care if you're saying, well, interest rates are low and it's justified. There's a lot of different ways to justify it for why it is where it is now. But everything's not going to stay in place. Everything's not going to stay in place, and you have to forecast longer out. So here, this chart is the red bars are the recessions, and this white line is a model that has a bunch of different inputs that looks and forecasts price gains for the S&P 500 over the next 10 years. And again, this looks like, okay, this is a nice chart, but this goes all the way back to 1970. So a lot happens in these short periods of time. So even here, so again, this is the zero level. Anything below zero means your expected return for 10 years is below zero. So it stayed below zero. This looks like a nothing. On this, when you're going back to 1970, this area here in 1999 looks like nothing. This was over from this point to here. I mean, it's over 2 years. And even from here to here was 3 years worth of time. And this was 18 months. So looking back on it, okay, yeah, it doesn't seem that long. But if you were actually in the moment, that is a long period of time. Now, what's fascinating is this actually tracks. If you were to just lag the S&P 500 by 10 years, it is highly accurate. It's like 90% accurate in what those 10-year returns are. So this was the previous low, okay? Negative 3% returns. Now we fast forward to where we are. Going into 2018, expected returns were about as bad as they were in 2000. Now we have one little blip here where expected returns were positive, and that was October to December of 2018, where we had a 22% correction. And then we have another little blip here, which was March 2020, where we had a 30% correction. In each case, we bounced back and went further expected negative. And this time, further expected negative to where we sit today. Expected returns are negative 7.5% a year going forward the next 10 years. Not negative 7.5% total for 10 years. Negative 7.5% per year going forward for 10 years. Yeah, I don't know that this, we're not sure that this model is going to work this time. It has for the last 50 years, but that is not a good expected return going forward. And it's something that needs to, again, I'm not saying that this can't, this was 18 months. This here is 9 months. Can we stay down here for the next for another 9 months? Absolutely. Can it go from -7.5 to -10? Absolutely. There's no telling what it can do in the short term, but holding for the longer term at these types of valuations, expectations are they're the worst we've ever seen. So one of the things that's interesting is you hear a lot, well, okay, valuations matter, and some of them don't matter, but if you own good companies, if there's a good company out there, they're going to grow into that valuation. There's nobody else like them. So I want to share something here which is fairly interesting. Here's two charts, and again, you probably can't even read what these companies are, but they look fairly similar. This down here, this chart, the bottom one, is actually Cisco from 1990 to 2000, so a 10-year chart of Cisco. And this one up here is a 10-year chart of Tesla. They look very, very similar. And what's interesting is from this point going forward, Cisco going into 2000 was a good company. They were going to change the world, and they did. And they're still a good company that generates lots of profit. And guess what? Tesla is a good company, and they may generate lots of profit in the future too. But that doesn't, you're discounting these types of moves. They discount a lot of what's going to happen into the future. And again, I go back to that quote, parabolic moves. This is a parabolic move. This is a parabolic move. They do not resolve by going sideways. I'm not saying that 900 or 850 on Tesla is the top. I'm not saying it can't go from 900 to 1800. It absolutely can. But when it resolves, it's not going to resolve by staying at that level. It is going to drop because fundamentals need to catch up to the price. So one of the things that, again, we're making a lot of comparisons to the dot-com time period. And one of the things I get all the time is this isn't .com. .com was ridiculous. We had all these companies. None of them had products. None of them actually made any money. We've got real companies that are going to change the world. And again, I'm not one to argue with these companies. They absolutely may change the world. In fact, we're seeing some of the companies that were hot in 2000 are now getting hot again right now. They didn't change the world over the last 20 years. Maybe they will over the next 20 years. I have no idea. But one of the arguments is, oh, these are real companies. What's fascinating is if you look, especially in the technology sector, this is a look at companies of the market cap of companies that have negative earnings. Again, not producing any earnings. And you can see for most of the time, there's not much from the 1990s. And then you have this burst, 1999, 2000, where there was a gigantic amount of market cap based on negative earning companies. Obviously, we saw where that went. And now you get into the 2000s, and you can see here, very, very few, it starts to pick up. And now we see this exponential increase in 2020. So again, maybe these companies are different. Maybe they're absolutely going to change the world. And guess what? There will be some companies that change the world. There's going to be a few that do. But with the amount that are coming out, there's going to be a lot that fail. And so, we talked a lot about this. We'll just take a little bit of time to have some fun. There's the economy, there's valuations, yet prices are still going up. Why the disconnect? And this one's kind of funny, this cartoon. It's the guy says, it's Peter Pan, I'm taking you to a magical never land that is unaffected by events in the real world. And this kid says, we're going to Wall Street. So, again, it's kind of funny, but you get the question all the time. We have COVID cases that are going up, and we have political issues, and there's an impeachment. There's a lot of different things that are happening. We've got record deaths, we've got record cases, all these different things that are happening in the real world, and yet we continue to go up. Well, it's just what happens sometimes. So now we're going to start to get into sentiment. And sentiment is a very, very important gauge of what's going on in real time, and then also what can happen in some type of mean reversion. And so here we look at sentiment from this is a model, and it looks at sentiment and positioning in the markets, and it gauges what's happening. So this is a model that's run by Citigroup. And here, so this line here, anything above this blue line is considered euphoria. Anything below this blue line is considered panic. And in general, you tend to be in the panic area a lot more than you are in euphoria. And most of the time, you're actually in between, somewhere in between. Now, again, this is a long time period. This goes all the way back to 1987. And to the point where this level, the reason why they put this level in here is once you get above here, Citigroup actually puts a 100% probability towards downside in the market over the next month. They don't do magnitude, but it actually predicts downside. And what's interesting is every time, even over the last bull market, every time we've even touched this, we've had major corrections. Whether it would be 2000 to 2010, even here 2011. This is the one in 2016. This is the one in 2008, and now we get to this one in. This is March 2020. We got into panic territory. So you get into, that's a good buying opportunity. Then we get here, and it just the explosion that we saw after it was just dramatic. It came back a little bit, and now recently, over the last couple, where they actually had to rescale this. We have never seen it, and that type of move higher, never seen it, other than this period when we saw it during the dot-com bubble. And again, this happened towards the end. This happened towards the end of the dot-com bubble, where you saw that euphoria. So again, does that mean we can't go from 1.8 to 2.5 and get even more? Doesn't mean that. It just means that, boy, anything, any bit of risk that comes in that's unexpected is going to really hurt. So one of the other explanations that I hear a lot is, yeah, this is, things are going to be going well. Everybody's still very, very underinvested. There's a lot of cash on the sidelines that needs to come into this market. And with yields so low, it's not going to go into bonds, it's going to go into stocks. And I say, really, because here's, again, this goes all the way back to 1955. This is the S&P 500 in black, and this blue is actually equities as a percent of total assets. So it shows where people are, how much of their asset allocation is in stocks. And here you go. This red line is this was actually the Nifty 50 bubble. It got there. We got slightly above it in the dot-com bubble, and now really since 2018 we have been sitting significantly higher. And even so, again, this little blip here, that's the 22% correction in December of 2018. And this blip here is March 2020, where we simply just got back. We barely got below record stock allocations. Barely got below, meaning everybody's pretty much all in on this market at this point in time. It doesn't mean we can't stay at an elevated level for a while because interest rates stay low, but it does tell you that how much more cash can come into this market to continue to buy. And the reason why I bring that up is this level here, you can see we stayed below the green line for a long period of time in the 1980s, which also happened to be a fantastic time to be in the stock market. But part of the reason there was interest rates at that point in time were, you're talking about 15, 18% interest rates. I mean, if we had that now, there'd be no point in being invested in stocks. So one of the things that's interesting as well is, we talk about, especially coming out of 2008, talk about capital markets and how they're working. And part of the reason why the Fed stepped in as aggressively as they did in March was because they didn't want to repeat of 2008. They wanted the capital markets to work. And so if people are able to take out debt and issue equity, then it should help the company survive. And so one of the things that's interesting, I was on a panel, an alumni panel with Wall Street alumni panel for Carnegie Mellon a couple days ago. And one of the panelists was this guy, Kevin Wilsey from JP Morgan. And one of the questions was, okay, well, what do you see going on? His quote, and I loved it, was, "When the ducks are quacking, we like to feed them." And so what that basically means is, it doesn't really matter what's going forward, but if there's an appetite, everybody wants something. They want to get involved. they want more debt, they want more equity. If they want it, well, that's our business. We're going to give it to them. We don't care what the consequences are in the future. We're going to give it to them. And so you look at IPO issuance, and what's fascinating is 1999, 2000, you had 108, 107 billion in IPO issuance. And then it actually dropped. So here's the bottom of the bear market. You had 18 billion. And then it started to come back nicely and then dropped again, bottom of the bear market in 2009, 27 billion. So you can see it started to spike up again, 96 billion. Then you saw this drop off again. And this was a tough time period for the economy going into 2016. And a tough period for the market. So it spiked and dropped and never quite got this high. Then you go to 2020 and it blows away what we saw in 1999 and 2000. So people are they're trying to issue and raise equity as fast as they can. They got to do it while they can. And now what's even more interesting is it's not even, if you add this in, it's not even just IPOs, the traditional IPOs. Now we have this thing called SPACs. And what's fascinating here is, go back to 2009, there was no SPACs. And there was a couple, 2010, it started, and you had a little bit more, started to take shape 2018, 17, 18, 19. And then you saw this explosion in 2020 in these SPACs. A SPAC is a special purpose acquisition corp. What this is, a SPAC goes public. They raise money. So we'll say $250 billion or $250 million. The company doesn't actually own it. And what happens is they raise the money, and then they go in with the money raised, and then they go and they find a company to acquire. And it's a very, very fast way to raise money and become public and then have a public company. So not only that, not only is there 74 billion on top of what's going on with the IPO, but you also have these SPACs to the point where they're raising, I think, 5 to 11 new SPACs a day in 2021. So we're 2 weeks into 2021, 2.5 weeks into 2021. And we've already done 25% of the amount of SPACs we did in all of 2020. So this is, the ducks are quacking. There is just an absolute frenzy right now. So, okay, so we've gone through all that. But now let's look at, so we've got sentiment. Things are obviously frothy. Now let's look at, is this long-term? Are people doing it in a responsible way, or are they speculating? And what's happening is the belief, what can go wrong? Going back to the original slide. There's a belief that the Fed or the government will always bail us out. They did in 2008. They did in 2020. They did several times over, going even between 2008 and 2020. If they're always going to bail you out, it creates a moral hazard. And what do I mean by that? So you get your $2,000 stimulus back in March. And some people absolutely needed it. Some people didn't need it as much. And then, things don't get better as quick as they expect. So we get another $600 in December. And now with the new administration, they're talking about another $2,000. So if you have money that, again, some people absolutely need it. Some people don't. If you don't need it, then why not take that money? Again, it's not your money. It's free money. Why not take that and gamble that? If you can turn that $2,000 into $20,000, then great, you're rich. If you blow it all, who cares? Because the government's going to give me more money in the future anyway. Maybe that one will work out. So it creates this moral hazard. Now, to walk through this chart, this is options. These are call options. So a call option, when you're buying a call option, you're basically saying the price of this stock is going to go up above a certain price in a certain period of time. If you're right, you make a lot of money. If you're wrong, you lose everything. So it's a very leveraged way to play. And again, you have to be right in a certain period of time. It's not like if you buy a stock and you're wrong for a couple of years, and then all of a sudden you end up being right several years down the road, then you end up being okay, as long as you don't sell. This is totally different. If you're wrong, you lose everything. So we're going to look at the different contract sizes. So there's institutional investors, retail investors, and everybody can do it. So here, the blue line is small contracts, under 10. The green is greater than 50 contracts, and gray is 11 to 49 contracts. What's fascinating here is the gray line is pretty, it was higher, and then it's stayed pretty much stable for the last 20 years. The green line was up higher going into continued to go up as the bear market was bottoming from 2000 to 2003, and then they slowly came back down. So again, this is the institutional traders. This is somebody in between, and then the blue line is the retail traders. And you can see going back at the peak of 2000 was the peak in the retail trader. They traded more than the institutional traders. That was the peak. They dropped as the bear market happened. They stopped buying call options, and for the most case, they stopped buying call options for the last 20 years. Starting in 2008, you can see the trend is started to buy a little bit more, and then you get into 2020, and there was an explosion higher in retail call option buying, and institutions, again, probably peaked for this cycle, actually probably more in 2016, got back up there in 2018, and then really fell off. Again, this is, going back to the economy, this was the peak in the economy, was 2018. Again, I don't think it's any coincidence. So the question you get is, okay, so we have retail traders. The market's been going up. It can't be all retail traders that's moving the market, because they don't make up enough of the of what's happening. So here's a breakdown of the U.S. equity flow by year. So the green is retail flow, and the biggest one obviously is market makers. So back in 2010, it was 10%. And now the retail investor is 19.5%. So in the last 10 years, it's almost doubled the amount. What's fascinating here is take a look at hedge funds. Hedge funds is pink. Hedge funds make up 9% of daily trading volume. Retail investors make up 20%. More than double what a hedge fund does to move the market. So now we're going to take it one step further because we already talked about the options trades. Now, if you're just trading stocks, you're buying, somebody else is selling, market makers don't really do anything. They just match people up. Okay, but the options market is different. In an options market, if you're buying an option, the market maker sells you that option, and then they have to go ahead and hedge themselves by buying the underlying stock. And there's a reason why it's different, and that's why there's open interest in options, meaning there's options that are out there, they're open. So without getting into too much detail, if there's an explosion of options trading and market makers then are short options, then they have to go in and buy the stock to hedge their position. So if the market makers are buying stock, and then you've got retail investors buying stock, and you add them together, that's actually 63% of all volume. So there's this positive feedback. And additionally, if it was on the negative side, there's this negative feedback. So this is a big market phenomenon. If you want to get into more detail, we can. That's the most I'm going to talk about it for right now. But the point on this one is retail can drive the market, and it is right now. So as you get more into the speculation, so we've had the moves, people have made some money, we've gotten into call options, and a lot of the bigger cap stocks have started stalling out, so they need more juice. I need more returns. And so where do you go? They go to penny stocks. Penny stocks trade under $1. And what's amazing here is, so this looks at, this is the S&P up here. But what's more important is the volume down here, these blue lines of penny stocks going back to 2012. So you see there's an increase in 2012, there's an increase in 2014, but generally it stays pretty low. Now you get to 2020, and all of a sudden, it stays pretty low, it picks up a little bit, and all of a sudden in December, there's an absolute explosion. Over 1 trillion shares of penny stocks traded in December. That is a big increase. And so, again, but it's only a few people. There's retail traders. They can't have too much of an effect. Here's from one day in the first week in January, 6 of the 10 most active stocks in the entire market were priced under $1. They combined for 2.6 billion shares, which was 18% of the entire stock market volume in one day. That just shows the amount of speculation that's going on. And what's funny is here, this first company, the biggest shares traded was Zomedica. And probably, what the heck is Zomedica? I have no idea what they are. Zomedica, the reason why it went up, and I don't know if anybody here watched the Netflix documentary Tiger King, but there was a character in there called named Carol Baskin, and she has a pretty big following online. And there's this other company called Cameo where you can pay somebody that's famous to create a 30-second video for you, and you get to tell them what you want to say. She got paid to say that she uses that Zomedica. Anybody who likes big cats really needs to look at Zomedica, and it shot the stock higher like crazy. So it's not like this is a standalone. Trades right now are being done completely blindly with very, very little research. In fact, Reddit, TikTok, Instagram, these are the new stock tip platforms. And again, I'll take a look at why things are being done blindly. Here's another example. So again, Elon Musk, founder of Tesla, famous, very, very smart guy, very, very successful, one of the richest people in the world. And he comes out on January 7th and puts out a tweet that says, use Signal. Okay, maybe some people know or don't know. Signal is a competitor to WhatsApp. WhatsApp is one of the Facebook applications. It's a competitor. He's saying, use Signal. That's what he's talking about. So then this doesn't give a ticker symbol, nothing. That's all the tweet was. This is the company, SIGL, called Signal Advance. The stock goes, after this tweet, it goes up 24,842% in 1, 2, 3 days. Stock goes up that much. Now here's the kicker. Signal Advance is a medical device company that has one employee and has nothing to do with the Signal app. And yet the stock price went up 24,000% in 2 days. And then again, okay, it came back down to $8.50. It's still trading at $13 today, well after the fact, 8 days after the fact of this tweet, and still people haven't realized it. Again, that is an example of what's being done right now. And so one of the things to talk about is, okay, well, things are different. It's a new paradigm. Well, guess what? Things have changed. They have changed recently. Institutional investors, going back to the percent, the other one, they're fully invested. They're fully allocated. So what's left is the retail investor is the only game that's left. They're taking their stimulus money. They're taking whatever money they have. They're seeing these big gains from other people, from friends, from coworkers, and they've got money that they've never. That's what's left. That is the new money that's coming in. And what's fascinating is, look at this. Look at towards the end of the year. You've got the S&P, you've got the retail favorite index, and you can see at the same time of all the speculations, all the options, all the penny stocks, all of a sudden, as the S&P 500 has its move and then is traded sideways, the retail favorite index has continued to spike. So again, the retail investor is what's driving the market. In fact, even if you go back to July or August, the big names, the fundamental names that did spectacular during the pandemic, the Amazons, the Apples, the Facebooks, all the big cap tech names, they peaked in July and August, and they've gone nowhere since. And that's their companies are so big that the retail investor cannot move those share prices. You need institutions, but the retail investor can move smaller companies, and that's what's happening. So let's try to put this all together. Right now, the economic data is virtually worthless because of the shutdown and reopening of the economy. And you really won't know until we take the crutch of the Federal Reserve and the government off of what's happening. Also, every sign of a bubble is in place. Every sign. Doesn't mean it can't get bigger, but it's just a matter of time to see what will eventually pop it. It's there. It's absolutely there. We're in the middle of it. There are, even though there's a bubble in certain areas, there are some companies that are attractive from a fundamental perspective. But these are pretty boring companies, out of favor, And nobody really wants to own them, because why would you own this company that you might make a 10% a year return over the next 5 years, when you can own something that's going to go up 10% a day? But there are still attractive companies out there, and life's going to go back to normal. The vaccines are coming. This is going to be great for everyone from a personal and actually on an economic point of view. So before I get to where to go forward, I just want to talk and go back about the bull market, bear market. Generational bottoms happen when investors have given up. And part of the bull reasoning was March was a bear market and we started a new bull market. And I'm going to go out and say March was absolutely not a bear market. It was a correction in a bull market. It was way too quick. And in fact, as we go down to look at this chart, here's all the bear market lows from going back to 1949. Here's there's 8 different conditions here of what marks a bear market bottom. It doesn't have to meet all the conditions, but usually it meets some. March 23rd, 2020 is absolutely zero. No conditions were met to meet a bear market bottom. Now, does this mean that we're going to absolutely go back and retest those March lows? Maybe. Does it mean we could go below those? Maybe. Does it mean, there's no certain answer. But what it does say is that there is going to be, the more we go up in a parabolic way, the way we are right now, especially in certain stocks, the less likely it is that it resolves itself by going sideways. And the more likely it is that we experience some type of pain. So looking forward, timing the end of this speculation it's impossible. It is absolutely impossible to know when it's going to stop. And in fact, we won't know what it looks like until after the fact. It could be like 2000 and 2003, where there was a slow bleed, the economy was okay, valuations were high, corporate earnings were going up, we'd have pullbacks, and then people would buy their stocks because guess what? Corporate earnings are okay, the economy's okay, we're going to buy our stocks. And then they were sold again. And then they were bought, and then they were sold, and it took 3 years for it to play out. Or it could be a sudden crash overnight, like 1987. We lose 30% overnight, simply because whatever stock market mechanisms, maybe it's this options market blows up because it just can't handle the amount of volume, and it causes a blow up and get a crash like 1987. Or maybe it's something completely different, but it's going to have to resolve itself lower. Next, the exit from the Federal Reserve and the government stimulus, it's going to cause some bumps in the road no matter what. Hopefully, it's just bumps and not something catastrophic. But even from 2008 to 2020, every time they tried to exit, it caused a major, major problem in the economy and stocks. And what we just did in 2020 dwarfs what we did in 2008. So if we couldn't get out of it last time, how are we going to get out of it now? It's going to cause some bumps. Now, bonds are just as dangerous as stocks and are just as expensive. And long-term expectations for both bonds and stocks are the worst we've ever seen. So what does that mean? That there's also going to be a rotation from these high flyers to perceive the value. It's not going to happen overnight, but it will happen. And this perceived value is a place to be, and a place where, as long as you're risk controlled, you will be able to make money, even though expected returns are negative 7.5% a year going forward. So what's the course of action? Absolutely continue to have some risk management. Look for relative value plays where there is room for upside, including international markets. That's going to be, there's a lot of value in international markets. You sell covered calls. Sell covered calls. There's huge premiums still in these calls because of the amount of speculation that's going on. It will enhance income, it will mitigate risk, and it will enhance return going forward. And then use stop losses. You have to keep them under your holdings. It takes the emotion out of it. You move them up as prices move higher. Sometimes you're going to sell at a stop loss, and then the stock's going to go right back up. But it avoids the emotion of getting in, getting out, and churning an account, you'll end up worse off. Keep the stop losses in place. And you have to look at hard assets. Hard assets such as gold, silver, natural gas, well, other commodities, nickel, lithium. There's got to be, hard assets are at the lowest relative valuation to stocks and bonds in history. It's going to, as this monetary experiment unfolds, hard assets are going to play a big place in a portfolio. So I just want to say thank you for everybody for attending today. What I have here, I didn't even go through a fraction of what I could. And so I have this link here. You can click on it. You'll actually get a page after you exit this webinar. You can go right to there. It has my calendar. You can pick a 30-minute slot. We'll schedule some time. We can do a meeting. I can share my screen. We can go more in depth into the economy. We can go more in depth into some of the speculative positioning. We can go more in depth even to where we see some relative value plays and explain the difference between certain stocks. So there's a lot of things that we can go into depth on. I encourage you to set a follow-up. If you don't want to use Calendar, you can email me directly because there's a lot of information out there, and I think it's a very pertinent time to be looking at it. So once again, if you get a chance, go through here, schedule some time, and we can follow up. Again, thanks again for your time, and enjoy the day and enjoy the weekend.